Hello, and thank you for joining us for IMN's NPL Notes and Default Servicing webcast series. This is Maddie Heckman, Program Director at IMN. Today's discussion is a July update, what you need to know about the NPL market. We have a wonderful group of experts lined up to discuss this, and I'd like to thank them for being here to share their expertise. Today, we will have a 60-minute panel, which will be moderated by Karin Gatos. And before I hand things over to Karin, I have a few housekeeping items I'd like to cover. There's a Q&A button at the bottom of your screen. Please feel free to submit questions throughout the webcast. You can upvote questions from other people, and popular questions will be prioritized and addressed first by our moderator. The webcast will be recorded and shared with you in a follow-up email from IMN. And finally, there will be a short survey in your browser when you leave the webcast, and we would greatly appreciate it if you would take 2 minutes to complete this. Without further ado, I would like to introduce Karin Gatos, Managing Partner at Pikes Peak Capital, and founded in 2017. Pikes Peak Capital pursues distressed, opportunistic REO assets and real estate related investment opportunities across the nation and provides alternative mortgages to income qualifying families across the US. Thanks, Karin.
Thank you so much, Maddie. And thank you everyone for joining us this afternoon. We have a really great lineup of panelists here with lots of industry experience. And I'd like to get right into introducing them. So first up is Nicole Matashevsky. She's the director of Angelo Gordon and Company. Nicole, would you mind giving us a brief introduction about yourself and your company?
Sure. So I've been at Angelo Gordon for 6.5 years. For those of you that don't know, Angelo Gordon is a large private equity firm, about 35 billion assets under management. I work primarily in the whole loan group on RPL and NPL strategies. So our group is, focused on buying NPLs, working them out, selling them as RPLs, or to the extent that's not possible, foreclosing and taking back REO. I've been in the industry about 15 years, so have a lot to share with everyone on NPL strategies and what we're seeing in the market today.
Great, thank you so much. Next up, we have Tom OGrady, who's the CEO of ProTech Valuation Intelligence. Tom, would you mind giving us a brief intro about yourself and about ProTech?
Thanks, Karin. It's great to be here. Happy to join the panel. So my background is in property valuation and appraisal. ProTech is a technology platform for fulfillment of any types of appraisal, evaluation, collateral due diligence. We provide a lot of data analytics on the housing market. I joined the company early in my career back in 1990. I've been the CEO since 1994. So I've seen a lot of the more challenging markets like we're heading into right now. But the company's active across the origination, servicing, capital market verticals. We provide a broad array of valuation due diligence products. Clients are the GSEs, 8 of the top 10 banks, 300 some odd other clients. And we've been very active both on the buy and sell side with NPL as well as RPL sales and securitizations. Thanks for having me.
Perfect. Thanks, Tom. And finally, we have Spencer Lee. Spencer is the managing member of Red Hawk Research, LLC. Spencer, would you mind giving us a brief intro about yourself and your company?
Sure. Thanks, Karin. So I'm managing member at Red Hawk Research. We are a data analytics and technology firm, and we build software products designed to solve data-intensive problems in verticals that we know well. I've been in the resi space for about 11 years and in consumer finance products for about 15 some odd years. Our main product in the resi market is Jonah, which is an analytical platform that's unique in its ability to effectively use data to manage an NPL portfolio. And really the platform is used by our clients to substantially improve timeline performance, identify and remedy remediate risk in their portfolios and the like. And really our approach is to essentially process and present data in a way that provides opportunities for operating efficiencies, improved resource allocation, analytical performance insights, and the like that can be used in the servicing environment and the asset management environment for marketing, bidding, trading, and the like. So that's it. Thanks.
Thanks so much, Spencer. Well, we've seen so many changes in the market over the past few months, and I'm sure everyone here is very interested to hear your perspectives. So I want to start with a few kind of broad market-related questions. First, how do you see macro market factors such as COVID-19 and the upcoming election affecting the NPL note market this quarter and for the rest of the year? Nicole, let's start with you.
Obviously, COVID has had a huge impact on both the RPL and NPL markets. Primarily right now with NPLs, you're seeing uncertainty and lack of clarity surrounding foreclosure timelines. We've seen every state impose their own moratorium. The agencies and HUD have come out with their own set of guidelines that people are trying to understand what are best practices. As every day goes on, there's new laws being proposed, things settled that we and the servicers don't understand how to sort of operate in this market. So I think it's been challenging trying to properly assess risk and how we're going to move forward. With every day, there becomes more clarity, but there's still a lot of uncertainty right now. Obviously, COVID's driving a lot of the new defaults. So with that comes the forbearance request and sort of how to move forward. The election seems to be challenging. There's a lot of uncertainty there as well. There's been talk of, national housing policies, I think, that are concerning. And we don't know how that's going to sort of shake out as well. So, we've got our eyes and ears open every day of what's happening. But, it's been challenging.
Absolutely. Tom, how about you?
Thanks, Karen. I think, COVID is, we're all in this together, as they say, and it's having a huge impact on the NPL market. I think the biggest thing, we see from our perspective is unemployment, historic unemployment levels since the Great Depression, as high as 14% back in April. It's good to see it moving back in that, direction. And I think with forbearance and the moratoriums, it's kind of keeping things afloat. But, I think the other shoe might drop. All these small businesses that got PPP loans, they're running to the end of their 8 weeks. And, we don't know what Congress and the Treasury are going to come up with next. But, those people have kept a lot of people employed with that short-term help. So we could see a lot more unemployment coming from there. If the spike comes again, and people are coming off their $600 extra payment, with unemployment, I think we could see a lot more long-term unemployment. We were all hopeful this would be a V, but I think it's going to be more of that W. And I think this is going to follow us until well into next year. And I think the NPL pools are going to grow significantly, and it's going to be a lot to work through in over the next few years.
Absolutely. Spencer, do you have anything else to add?
Sure. I think as it relates to the election, I think our general view is that it's positive regardless of the outcome, simply because it'll just establish some measure of certainty, right? I think there's just so much uncertainty at this point as to when we get from here to November, that just getting past that point will allow a lot of people to at least begin to plan and map out how the following 12, 24, 36 months goes. In a Trump re-election scenario, our general view is that there'll be a continued push towards economic activity over disease management. So how that really sort of affects housing policy, how that really affects the default rates, can be sort of planned for in that kind of context. In a Biden administration, our view is that taxes will go up and on the wealthy. It'll go up on corporates. But on the flip side, you'll probably have more focused disease management, which may stem some economic activity in the near term. But once economic activity returns, you'll probably have sort of more permanence in that return of economic activity. The big shift will be whether you get a shift in both the White House and the Senate. And if it goes, all Democrat, you're going to see, to Nicole's point, some significant policy issues that may have some real major impacts. I think on the employment front, clearly we have yet to see an impact on white-collar jobs. And once that happens, that could sort of be another leg down, certainly in a different probably segment of the sort of housing, the value segment. But that I think is something that, in our view, we haven't seen yet, because corporates are really trying not to shake the boat too much in advance of the election. And then from the regulatory front, I think we've seen a lot of clarity emerge over the last month, as a number of these state level moratoria have begun to expire. So, 7 states never even implemented any type of moratorium on foreclosure and evictions. 21 states over the past couple of months have let their existing moratoria and on evictions and foreclosures expire. So those obviously don't include some of the more populous states like the New Yorks and the Californias, but Texas is in that group, Georgia's in that group, the Carolinas are in there, Virginia's in there, Michigan's in there. So you are seeing some significant sort of loosening, and there's obviously some local municipalities that do have some continuing restrictions, but that is loosening up. We're seeing assets move forward and the like. So I think we are seeing an increasing level of clarity around how this market's sort of shaking out.
Great, thanks so much. So digging a little bit deeper into the pandemic side, how are you seeing that note buyers are responding to the pandemic, and where do you see today's opportunities? Nicole, let's start with you again.
We're certainly seeing there's sort of a pent-up demand. I don't know if there appears to be a lack of supply. Without foreclosures, there's no REO. I think people are still trying to assess their portfolio and figure out what would they want to sell. It does seem like there's some small opportunities with opportunistic sellers that are trying to clean up books or sell certain portions that they're concerned about. So we've definitely seen more trading activity on the smaller side. And, obviously, like Tom and Spencer said, we expect more NPLs in the future. So I think, we're expecting more pools and more note opportunities out there probably towards the end of the year or early next year as we sort of work through all this. I think I've read a lot of research reports recently that said there'll be definitely smaller pools out there and other opportunities, with some early buyout products and other stuff like that. So I think it's coming. There's definitely going to be more opportunities. You'll see people try to get rid of risk in certain areas that they're concerned about, certain types of loans, seeing how all the unemployment shakes out, high balance, low balance, certain cities where you're concerned about timelines or valuations. So there's definitely opportunity coming, but it's been slower today.
Right, great point. Tom, how about you?
I think the foreclosure moratoriums are the big question mark, and probably what's slowing down the activity. So we do see customers putting pools out, and we see buyers bidding on them, but I think the prices are still low, and I think everyone's really just waiting to see what's going to happen with these moratoriums. As we know, in June, FHFA extended the then moratorium of June 30th out to August 31st. I believe California has a bill pending that's talking about a 180-day stay on foreclosures after the end of the COVID emergency period. And I think there's language in there about a borrower being able to request an additional 180 days at the end of that. So, I mean, you're going to have, both obviously federal and state pushing this out, and we don't know how long it's going to get pushed out. And I think that's the biggest thing we see is hesitation and it affecting pricing, just that sort of unknown. If you're going to buy a pool, what your exit strategy is if they're not performing.
Right, right. Great points there. Spencer?
Yeah, really outside of the first couple weeks, month or so, when there were a couple of folks who had margin calls that they had to meet, it's been what we've sort of seen among, our clients and folks that we sort of regularly are in touch with is that very little movement. The bid-ask spreads appear to be extremely large, almost comical in some states, but that's really until, again, I think there's just such a lack of certainty that needs to sort of coalesce first. Right.
That's a great point that you brought up, Spencer. And actually, we just had a question from the audience asking, this person said that they're seeing widening in spreads for trading, and they think the pattern will progress negatively for the next 24 months. What are you seeing? So Spencer, you mentioned that you're seeing a very large bid-ask spread. Nicole and Tom, how about you?
We've seen definitely, widening for sure. As far as 24 months, that seems like a long period. I think it's too long of a timeline and too many factors right now to figure out how long that's going to continue. But with more certainty, we'll sort of bring those spreads closer together. You have to be conservative in your assumptions with timelines. Valuations have somewhat stayed stable right now. So I think it's really about timeline exposure and, getting through the process to enforce the note. Right now we don't know or it's not very clear the process by which you're going to have to go in front of a judge and argue that you've done everything you needed to do, that you've provided all the assurances for forbearance and get to the end result. So right now there's moratoriums, then there's court backlogs. And then there's going to be this other process that's unknown. And especially it's going to be very key in these difficult states, New York being at the top of the list. How do you convince a judge that you've given the borrower every chance to go on forbearance, especially in a state like New York that has, mandatory forbearance, and the factors are not very clear. It just says COVID affected, so they don't have to provide documentation. So it's really available for everybody, especially deeply delinquent NPL borrowers. So somebody could be 10 years delinquent and be eligible for COVID forbearance. So as that clarity becomes more clear and people try to foreclose and you understand all these nuances, you should see that spread widening come in.
Great. We have another question from the audience related to opportunity. The question is, have you seen any NPL subsets that have become more attractive as a result of COVID-19?
I haven't seen anything specifically myself. I could, come up with some that would be attractive, but I haven't seen anything sort of personally myself.
Got it. How about you, Tom and Spencer?
Yeah, I don't know. I think, one thing I'd mention is that this market's different. So the foreclosure forbearance is a challenge, but, if we compare to the Great Recession when everyone was upside down, there's so much equity. So I think there's a lot of other, workout paths other than foreclosure, with loan mods, deed in lieu, short sales. So I think that might keep things moving along, and maybe pools where you can see the pursuit of some of those options might keep pricing from dipping too low.
Right. All right, so moving on, what are some of the key factors that you see that are driving default rates in today's market? And what can we expect to change in the next few months? Nicole, let's start with you again.
Yeah, so on the default side, for new defaults, it's all COVID related. Obviously, we're not really seeing anything else going on. There could be other issues with people, but everybody's calling in saying they're COVID affected. Right now we're seeing the biggest drivers of that to be regen and sort of loan balance size, heavily weighted towards the higher balance loans that I had mentioned. And I think that's driven by, there's a very large percentage of borrowers that are, with lower balances that are collecting stimulus and extra unemployment. They get child credits. So you're seeing those people sort of still continue to pay and not calling in right now, electing the forbearance. So we think that those extra stimulus plans are really distorting the true picture of what might be coming for the defaults. So, I think this is not going to change probably until next year when the vaccine becomes more of a certainty, right? So towards the end of the year, early next year, that's where we'll sort of see things sort of, the true distortion of what's happening probably come to light. Especially, I think Spencer mentioned the unemployment that's coming with white collar jobs. That's obviously something that we've been monitoring and looking at too. There's a lot of, companies that are reporting profits down. So that's still, I think, TBD out there.
Great. Tom, how about you?
Yeah, I think the defaults are obviously directly correlated to unemployment, and with the COVID unemployment, that's what we're seeing. I think we were at a 10% unemployment back in the Great Recession, and default rates were, serious delinquencies were up at that same range. And if you track it over historic, the two are hand in hand. As one goes up, the other goes up. So I think that that's what we're looking at. We're looking at high unemployment. It's come down a little, but I think we're just going to have to see what happens with extension of PPP loans and stimulus and unemployment benefits. That can keep things from bleeding too fast, but that's not going to last forever. So we're kind of in this race of, how much is the federal government going to step in, and when are we going to have a vaccine so that everyone can get back to employment. So I believe the worst is to come, but that's the big driver. It's with unemployment, there's going to be delinquency, and there's going to be a lot more NPL activity because of that.
Absolutely. Spencer, what's your perspective?
Sure. It's very similar to what Tom and Nicole stated, and I think we're trying to sift through the distortions in the market that are being created by the stimulus, and the various points of data. And one of the things that I think our view is that the forbearance rates are not really the best metric to consider what future delinquency is going to be like, because there's a wealth of other data that points at significantly more severe kind of outcomes. The Census Bureau conducts very regular surveys on households, and in their most recent survey just earlier this month, 26% of households are currently experiencing what they define as housing insecurity, which is essentially either the inability to meet prior month's payment or the inability to meet this coming month's payment. So that type of data is what we're sort of looking at more. Up to some 50% of households have, according to Lending Tree, have lost some measure of income since the beginning of the pandemic. So these are all factors that lead to the view that delinquencies are going to be driven sort of significantly higher. So if you sort of assume that about 75 million households in the US are in units that are backed by a mortgage, and approximately 2/3 of those are sort of owner-occupied units, you sort of have to take your view of that delinquency rate, apply that to that base, and you're looking easily at potentially eight-figure levels of default units in the market. So that's kind of how we're trying to think about it.
I see. Great, thank you. I'm getting several questions from the audience related to valuations specifically, so I'd like to dive into a few of those. The first question is, I'm seeing REO pools come out where the homes are still occupied with eviction moratoriums. How are you looking at pricing reductions on them compared to vacant REO? Who'd like to jump in and answer this one?
Well, obviously there's a timeline extension there. So if you're just discounting it, it's worth less. But, for no buyers or people that are in certain markets, you still can do cash for keys. So if you know something about that set of loans that you're buying, you can go negotiate with the person and you can, successfully transfer them out of the home. So I don't think you have to go through the eviction process, especially if you have somebody that can go door knock these people, agents, or others. It's been so successful. Your worst type of tenant is somebody who's very knowledgeable about the eviction moratoriums and is going to hold on for a long time. But to some extent, there's a price for everything. So they know their time's up, and it's about money. So you have to kind of price out the timeline extension for that certain area and see if you're willing to pay them what they're asking for. But we've been successful in negotiating cash for keys still with the eviction moratoriums.
That's great to hear. Tom and Spencer, how about you? Are you seeing, I guess we could even extend this to say not just buyers of occupied REO, but NPL buyers as well? Are they assigning specific kind of discount values to in response to some of these eviction moratoriums?
Whether it's discounts per se or not, on the NPL side, there's clearly some opportunities just purely based on jurisdiction. So if we look at our entire universe of assets that are managed on our platform, only about 53% of those assets are on a COVID-specific hold, right? So you have an opportunity to work with borrowers that are not restricted or that are not otherwise on hold for COVID-specific reasons on, virtually, half of the country in a sense. And so, 12% of our entire platform, our entire book has no risk, is not on any type of hold whatsoever. So, this is where it's important and valuable to understand exactly what jurisdiction you're in, what states you're in, what you're allowed to do, and understand where your asset is in that default life cycle. So, I think an example is in New Jersey, not exactly considered the most friendly place to foreclose, but their foreclosure office is still accepting electronic filings and new actions being put in for non-GSE foreclosures and the like. And so this is where understanding what you're looking at, what you're buying, can really provide some real opportunities going forward.
Absolutely.
And just to add to that, I think understanding the equity in the property. Obviously, if there's equity, there's a lot of other options other than foreclosure.
Great point. And to that end, there's a couple questions here related to the value of the underlying asset. So one question is, any expectations of expected values of the underlying real estate to fall in 2020-21 for commercial and residential? If so, what is the expected percentage reduction of values? And another question very, very similar to that one. Nicole, what are your thoughts?
Yeah, I think we're expecting prices to stay stable for some period of time. I think that's, speaking to the country as a whole, you're going to find these pockets that will be very challenged. We're seeing certain cities where there is a lot of civil unrest. We're having a hard time sort of selling REO in those areas. We're also seeing a lack of demand for condos. So all these search functions, all these research reports out about what people actually want. Everybody wants a house in the suburbs right now with land, extra space to work from home. So you're seeing a move out of the large populated areas into sort of more rural neighborhoods, especially families or first-time home buyers. So you're going to see these pockets that have these valuation shifts that, don't seem to make a lot of sense. You're going to see extreme increases in sort of these nice rural neighborhoods and maybe decreases in some of the more popular cities. But generally, the expectation is, I think things stay stable for some period of time going into next year. But, Tom, I think you probably have some more information on that.
Yeah, Nicole, I would agree with you that, aggregately, when we look at U.S. housing prices over the next 12 months, they do look stable. We've seen, the realtors report that and all the economists. But I think, real estate's local, and unemployment's going to impact states like Florida more than others. These jurisdictions and foreclosure laws and moratoriums are going to affect markets. And, so when we look at the strength of markets and forecast out, we feel there's 11 states that are actually going to see a decline over the next 12 months. And then we look, a little bit closer than that, and at the 200 plus CBSAs that we track, we're looking at a third of those declining, 1 in 5 zip codes declining. So it all comes back to what's the local impact. So I think when you roll it all up, some markets going to appreciate. What's keeping things in such good shape on a national level is the lack of inventory is keeping prices up. More than 80% of CBSAs today have less than 6 months inventory, which is 6 months is always kind of what you think of a balanced market. So it's a seller's market, and that's keeping prices up. Those CBSAs I mentioned, 89% of those have fewer active listings than at the same time last year. So that's helping the overall market, but there will be, those zip codes and those counties that aren't as favorable for the reasons I mentioned.
Great. How about you, Spencer? Where do you see valuations going in the next 12 months?
Yeah, I mean, I think Tom's probably got the best perspective on that. And so, everything I've heard is consistent with what he said. I think the other, obviously housing stock has been low. It hasn't kept up with household formation over the last decade. The other factor that I think is really different now than was during the Great Financial Crisis, essentially, is that you have these very large institutional single-family rental players out there. So that's another entity on the demand side that will, I think, help support valuations to some degree. So I don't think you're going to see the 30% decline in property values or the 40% decline in property values that you saw sort of widespread during the GFC, but you will see some, but again, much more modest.
Great, thank you. Next, I'd like to dive into a couple questions sort of related to the due diligence side, and I see there's a few questions from the audience as well. One is, given the uncertain timelines, is it more important to make sure of the collateral quality and marketability? Tom and Spencer, I'm curious to hear what your thoughts are on this.
Yeah, I think absolutely. You need to get out there and look at that property and understand if there, obsolete condition issues. You need to understand the strength of that local market. I mentioned, the lack of inventory, but depending on, is it a foreclosure driven market or is it a fair market, transaction that's going on? How long are properties, on the market before they sell? How much inventory is there? Is it appreciating or depreciating? You've got to look at all those kind of current market analytics and forecast out. And, so I think if you have a property that's in a market that's going to be, like we're saying, overall, the housing market's going to stay strong, then, and you've got equity in that property, you've got a lot of options. Where we need to be careful is, as I mentioned, 1 in 5 zip codes are probably going to decline over the next 12 months. And so I think that's where you need to be really careful. Understand the market dynamics, what it looks like, today, but in the long run, understand what the REO and quick sale value discounts are in that market. If you do have to take it back, what are you looking at for loss severity? So there's a lot of due diligence to do on the collateral side.
Great point. The next question is, what are the best practices when determining property values in NPL pools, especially in today's market? Tom, do you want to take that one as well?
Yeah, I guess I don't want to repeat myself, but one of the things that we always look at is, what's driving the market. So, you know, if it's an REO market, then you need to value that property appropriately. If, you know, the REOs are not impacting the market, then obviously you're looking more at a fair market value. So, yeah, you need to understand the appropriate way to comp that property. And, you know, and you need to understand how strong or weak that market is. So it's comparable selection, but also understanding all those market dynamics to help you make the right comparable selection to drive that final value. Every market's different, so you know I don't think there's a single answer.
Right. Spencer, how about you? What do you see as some of the best practices?
I think it's very similar to, you know, what Tom is saying here. I don't have a tremendous amount to add to that. You know, fundamentally, it's going to be your strategy, right? And whatever that strategy is, your diligence has to match that, and your pricing has to match that. And you know, I think it's really a lack of discipline that really you know, or having that discipline is really what helps you sort of do well in those environments. So
absolutely.
And I would just add, really, you know, understanding, you know, that there's the current market value, which I was talking about, but it's also, you know, where's that market going to be in 12 months? And, you know, if you're going to have to take that property back, you know, what does that, you know, short sale or REO discount look like? So I think you really need to be looking at these properties with, you know, current collateral value, but, you know, future potential, you know, REO type discount value, and you know, understand what your potential loss severity is.
Great point. I have a question for Nicole here. What subsets do you view as more attractive due to COVID-19?
Yeah, so I think it's sort of what I mentioned before. You know, you're going to find these homes that are very valuable or attractive to people today. You know, your rural neighborhoods outside your large cities, certainly single family homes over condos we've seen an increased demand for. The prices are very attractive. You know, that's thinking more longer term when you eventually take the collateral back and try to sell it. We're seeing, you know, a higher demand for that sweet spot of the 200,000 to 300,000, that sort of first-time home buyer. You know, the higher balanced market is probably still challenged, and that's going to be regional specific too. But there's definitely these certain pockets that have a very high demand right now. So if you're looking at pools, you know, I think Tom mentioned this before. It's very geo-specific. It's almost zip code. So if you have the time and effort to put into going through that much diligence on a pool and really understanding a certain market, you might be able to sort of find a pool that works for you. You know, one other thing I want to mention is that I think Spencer highlighted this before. Stay very informed on what's happening in that state, in that county. We're seeing jurisdictions. It's you know, we've seen county to county doing different things with foreclosure moratoriums and evictions. So you have to stay really on top of what's happening in a certain area. If you transact in a certain state or a county, make sure you talk to attorneys, talk to your servicers, double and triple check all the information you're getting, because we've even seen attorneys have different opinions. So it's really, really important today to stay informed.
Great point.
Yeah, I'll just add to that, Karen, to Nicole's point. You do see, and we see this in the data in our platform, that for a single, you know, jurisdiction, be it state or even a county, you will have different firms take different approaches, and so it becomes clear that, you know, that is more of an asset management, potentially an asset management approach as well, right? Where you're saying, hey, you know, this, I know that we can take this step in the prosecution, you know, so we need to be doing that uniformly. So that's that level of awareness that you need to sort of have in order to be successful here.
Great, thank you. kind of moving on through a couple questions about diligence. So how does your organization perform due diligence in the current environment? Or if you work mostly with buyers, how are buyers adjusting their due diligence practices due to some of these foreclosure moratoriums and forbearance and the like? Nicole, let's start with you.
So, we haven't, obviously seen that many pools out for bid lately, but, generally how we perform diligence on NPLs, there's a lot of scrutiny on valuations, timelines, foreclosure impediments, title's a big thing. You got to make sure you have the right title. The longer the timeline that you see out there, the more likely there's a problem, litigation, title, other problems. So if you're talking about a COVID overlay over that type of diligence, that really relates back to your strategy. If you're looking to get people reperforming, you need to understand what is the likelihood of that happening within the pool. Looking at contact rates, looking at people that are on forbearance, how much of the people are calling in, trying to do modifications, cash flowing. If your strategy is really take back the collateral, then you need to do a lot of diligence surrounding the foreclosure timelines and making sure you're understanding, is there an impediment to that foreclosure timeline today? And if you're seeing something within that servicer of that pool that you're looking at, that may not be representative of an actual issue with that loan. You're going to see certain servicers who are just going to put everything on hold. So that just because you see something on hold or you see timelines extending, that doesn't necessarily mean that you can't move forward. So, you need to ask a lot of questions of why you're not seeing things move forward from that servicer or that investor you're buying the loans from, and also fact checking that away from attorneys saying, why are we not seeing these move forward? And the attorney will most likely say, well, that servicer just got those on hold. You're going to see people take a very conservative route today with putting their assets on hold. There's going to be a lot of scrutiny over procedures and protocols with everything COVID related, the states through their regular investigations and inquiries. So, a lot of servicers are going to be ultra conservative. So, you're going to have to add those COVID overlays on top of your regular diligence process to be successful in this market.
Great point. Tom or Spencer, did you want to add anything about that?
Well, from my perspective, due diligence, I'm really privy to the collateral due diligence and not the rest, not the underwriting. But when it comes to collateral due diligence, what buyers can do or are doing, I think looking at data analytics services where you can overlay current market trends and forecasted values, again at that local neighborhood zip code level, so that you can flag those properties that are at greater risk of in a depreciating type of market or a weak market. You can overlay an AVM with that also indicates what the REO and quick sale discount are. So again, a way to just sort of flag properties in the pool that are at greatest risk for overvaluation or future loss severity. A lot of times if you're a buyer, then the seller is providing, a broker price opinion or some kind of valuation. So, if you do those overlays, then I think you can target your reconciliation and, take a deeper dive on some of those properties that, have those risk flags on them. And, so you want a provider who can provide some kind of market reconciliation where they, can review the valuations provided to you, but, bring in additional market data, to make sure the value supported, the appropriate comps were used, understand a report like that can show you the strength and direction of that market, understanding if it's a, if it's a strong market or it's a foreclosure type driven market, and make sure that the approach to value reflects that.
Great.
Yeah, I would, sorry, Karen. I think Nicole's point again on sort of having a clear sense of, what are these third parties that you're using as part of that process to manage your portfolio? What are they doing? How are they approaching it? Servicers, attorneys, and the like. It's just very important. On our platform, we have 7 special servicers who have data sort of coming through. And so we can see through the data, clear differences in approach based on jurisdiction, based on philosophy, based on how conservative or aggressive they're willing to be. not only overall, but on a state level basis, on a portion of the process basis, and things of that nature. So those are all sort of, I think, important considerations if you're trying to optimize. And if you think about where we may end up being in 6 or 12 months when delinquencies come flooding on the market, and foreclosures sort of, the filings sort of begin to pile up, exactly, who you're working with, how they're going to process it, how on top of it they are, becomes sort of, significantly much more important. I mean, I remember, being on the asset management side of a large fund during the great financial crisis, and going down to Florida to an attorney firm visit at a firm that no longer is in existence, but just walking into their office, and literally their staff is neck deep in paper because they're just completely overwhelmed with the process. So that sort of extra level, that sort of overlay that I think Nicole was mentioning, and how do you measure that? How do you monitor that? Is really key, I think, and has a lot of downstream benefit or harm.
Great point. I have a kind of random question here from the audience. Is there any data, or what data are you seeing on the amount of NPLs nationwide at this time? Does anyone want to take that one?
Well, Black Knight just came out, I think, yesterday or earlier this week with their report on volumes, and I think they were close to sort of 1.8 million sort of deeply delinquent, not in foreclosure yet. So, call that 90 plus. I think there were a couple 100,000 in that neighborhood. My apologies, I don't recollect all these numbers straight off the top of my head that are in sort of pre-foreclosure. And then there's obviously several million that are in that sort of 30 plus to 90 kind of segment. So, but again, to sort of our earlier discussion, you see these stimulus benefits expiring, you see additional unemployment, these are just going to sort of exacerbate, and I think our view is that the trend is up, not down from this point, certainly in the volumes.
Right, absolutely.
Yeah, and I'd add to that, I think we're on the front end of this. So I don't think we see the serious delinquency 90-day yet, but we're seeing, the wave starting to form. 30-day delinquencies were 6.1% in April. So that was up 2.5% from a year prior, where it was at 3.6. So that's a dramatic change. Early stage delinquencies being that, 30 to 60 day, that hit its highest level in 21 years in April. So, like I said, I think that's the beginning of the wave that's starting to form, and it's going to grow, and those are going to fall into the 60 and 90-day bucket. I think we're just still early on. We do see a lot of servicers coming to us for valuations for potential loan mods. So I think a lot of the forbearance that was given was 3 months to start with a lot of that was a predominant, and as those are kind of now hitting that 3-month time frame, we see a lot of servicers looking at what's the value of the property, do we have a loan mod path here, or do we need to go in a different direction? So I think we're just again at the very front end of this.
Yeah, great point there. And there's actually a couple questions for the from the audience related to this. Sort of trying to figure out what's happening with the loans once they enter into loan modification. One question is, even with loan modification, the borrower may still raise their hand for a forbearance even after a loan is modified. What does this panel think about the likelihood of that happening and possible, responses?
Well, certainly that's possible. I think, though, if you have a clear process and protocol for how you're going to modify loans, I mean, you shouldn't really be trying to modify people that are still in the middle of a hardship, right? That's going to be a problem, probably get into a lot of trouble. And if you then don't extend forbearance after, that's going to raise eyebrows of anyone that you're coming in front of. So it's best to do your diligence to confirm the hardships over and have the borrower put it in writing that I can make this payment and, you know, you can move forward. Given the uncertainty about the future, about unemployment and what's going to happen in the country, when a vaccine's going to come out, who it's going to go to, how it's going to be accessible, all those questions, it's inevitably some people are going to default after they believe their initial hardship has been resolved. But through good practices and just working with your servicer and having a really good process, you know, you should be able to minimize that. But, you know, we have seen people calling in saying their hardship's over. So people are back to work in certain parts of the country. Even though cases are rising, people are still back to work and things are reopened. So, you know, it's kind of a mixed bag right now. We're seeing people who need further forbearance and people resolving the debt. So unlike the great financial crisis, borrowers are in contact. People are calling and they're asking for help trying to save their homes. So I think that's a stark difference from what we experienced before when we had a surge of foreclosures. These people actually really want to save their homes, as opposed to that type of borrower before that could never afford the house in the first place and just went dark on you. And then there was this bubble of foreclosures that overwhelmed the system. You know, I think today, why you saw all of the federal guidelines come out so quickly, because they were trying to avoid the mistakes they made before by not helping people as early as they should have. So, you know, hopefully with all of these programs and the borrower sort of being in contact, you can limit that foreclosure bubble. And really the ones that will go through the process are the ones who there's really no other sort of option for that borrower.
That's a great point. There's a related question here. Do you foresee a rise in deed in lieu foreclosures, especially as banks see an increase in their NPL inventory? Does anyone have thoughts on that?
Yeah, I would say, you know, there's a lot of paths before you get to foreclosure. And I think, you know, we've made a lot of comparisons to the Great Recession, but I think that's what's different. You know, even though people are unemployed, their property has a lot more equity. You know, you don't see people upside down like we did. The amount of equity growth in this country over the last 10 years is, you know, is dramatic. So I think people are sitting in a position where they have an asset that has equity, and therefore they have options. You know, deed in lieu, short sale, loan mod. So I think we'll see a lot more of that and less foreclosure compared to the last crisis.
Great.
I think one thing to add there is that when you start to look at the sort of net present value of the REO versus a deed in lieu, it's going to look more attractive to do the deed in lieu, and especially pay somebody cash for keys. You know, when you're dealing with uncertain timelines, if you're sort of pricing in a conservative scenario, that deed in lieu is going to look more attractive to you. Therefore, you might be willing to pay the borrower a little bit more money to move out than you would have with a more certain future.
That's a great point. Absolutely. Got a couple questions here from the audience about kind of subcategories of NPL. One is, how do you see the commercial real estate sector for NPL and REO? Do any of you work with commercial real estate?
I'm going to have to bow out on that one.
Nicole or Spencer?
No.
All right. Another question is related to senior NPL, and it's asking any stats on senior NPL versus junior NPL.
Was the question specific regarding?
Just, I guess, statistics or any differences in how the diligence is treated?
The diligence process that we look at for second liens really is about the value of the property and if there's any equity, right? So if you're looking at a paying second lien, you're going to price that if there's equity or not. You know, in non-performing, it's all equity based. There's be some probabilities that they'll continue to cash flow if they're already performing, but really it's the value of the property and what's the balance of the first lien. So if you have to take it through foreclosure, you know, what are you going to pay for that asset? But, you know, the second liens we've seen, you know, it's not a wholesale failure. They're still paying. Those people's payments are much smaller. So it seems like the same realm of a car payment, or, you know, it's a smaller number of your overall payments. So we're still seeing people sort of cash flow in this COVID world. So it's not like, you know, every second lien has just defaulted.
Right, right. All right, just a couple more questions here. We're getting short on time, but how has title insurance changed in the NPL market? Tom, let's start with you. Unfortunately, you're on mute.
I'm going to have to pass to one of my other panel members. I don't deal with title, so I.
All right. Nicole?
We haven't seen, you know, many changes in the title insurance realm, but we are hearing in certain states that have anti-gathering laws today that your title insurance could be challenged in the future because of some state and local the anti-gathering doesn't allow a proper amount of people to come bid the property. So you haven't done your due diligence to sell it. Perhaps if you use auction platforms or that kind of stuff, that's a good argument. But, you know, in a state like California, we're getting some very varied opinions from council. So that's one state that's definitely been on the radar. That's very COVID specific related to title insurance. So, you know, that's another sort of thing you might want to check when you have certain states or exposures in areas, you know, confirm with council or even your servicers, have they been able to place title insurance on any of the properties they've recently foreclosed on? So that's sort of another aspect to all of this that you'll want to confirm that you can actually place, you know, get title insurance if you eventually foreclose.
Great. Okay, perfect. And then finally, what are some successful approaches to managing NPL assets? Spencer, do you have any thoughts on that?
I mean, I have a bit of a bias, I guess, view, given our platform is designed to make that whole process more efficient. But, you know, the traditional approach has always been a very sort of expensive, laborious asset by asset approach. And really our approach has always been, you know, be able to do that analytic on scale at a portfolio level so that you can identify, you know, pockets of risk. So if you have an asset that has certain characteristics of risk, how can you quickly and easily identify all the other assets with similar dimensions of risk so that you can deal with those quickly? So you know, that's I think the approach where you can improve your resource allocation, right? You're not having to go through every single asset to figure out which ones to go through. And that's really was, you know, born out of a lot of painful personal experience doing that. But that's where we think the ability, you know, whether it's a judicial state or a non-judicial state, whether you have a lot, whether the process is very opaque or the process is very simple, that type of ability to leverage technology for that purpose is what we think is important.
Great, thank you so much. Well, panelists, unfortunately, we're out of time. I wanted to thank you all so much for being here and also thank the audience for your engagement. We had about 300 folks attending this, and unfortunately, we didn't get to all the questions, and we still have about 10, but very much appreciate everyone's engagement and participation today.
Thanks, Karin. And thank you to all of our panelists. I hope everyone found the webcast to be of value. I'd like to thank Karin, Tom, Nicole, and Spencer for their time and expertise here. The recording of this session will be shared with all of you in a follow-up email from IMN. And as mentioned earlier, please take a moment to fill out the short survey that pops up in your browser when you leave the webcast. Finally, thank you all for joining us today. Keep safe, and we look forward to seeing you back here for IMN's next NPL Notes and Default Servicing webcast. Thank you.
Thank you.
Thank you.